Dublin's hotel pipeline is experiencing its most active development period in a decade, with over 430 new quays entering the planning stages. This influx is amplified by a proposed $900 million speculative mixed-use development currently moving through the pre-development phase. This topographical map outlines three distinct zones requiring independent underwriting. In the Bridge Street district, new inventory creates measurable pressure on existing margins. The West Innovation District zoning catalyst clears the path for large-scale development. Meanwhile, the Metro Center favors adaptive reuse and residential conversion. If capital is allocated based on citywide growth metrics alone, these localized shifts will lead to a significant misalignment between supply and projected revenue. To navigate the supply disruption expected between 2027 and 2029, investors must track specific municipal legislation and localized oversupply. This street-level map of the Bridge Street district shows the immediate supply trajectory. 280 premium keys are entering the corridor. The first project is Tempo by Hilton, a 150-key property opening in 2028. The second is the Autograph Collection at Block Y, a 130-key asset. These two projects are advancing within 18 to 24 months of each other, concentrating new supply in a single corridor. The developers of the Block Y asset are utilizing a new Community Authority, or NCA, expansion to secure specific financial offsets. This document details how the NCA expansion provides a 25% bed tax rebate through 2067, which effectively lowers long-term operating costs. As these new assets open, they will capture a portion of the corporate and leisure demand that currently flows to older properties. The AC Marriott and Spring Hill Suites are the existing assets positioned most directly in the path of this demand shift. This projection correlates supply growth with operational performance. As the bar chart representing 280 new keys scales up through 2028, existing assets' average revenue per available room is expected to decline. We expect the impact on margins to begin appearing in late 2026. To further protect these new developments, developers are attempting to replicate the dual TIF structures used in earlier phases of Bridge Park. For those holding existing assets in the Bridge Street district, the current pipeline represents a significant localized supply challenge. This map of the West Innovation District reveals a mismatch between demand and infrastructure. The area contains major activity centers, but zero hotel rooms. The primary demand driver is the premier athletic and recreation campus, which includes the 243-acre SportsOhio complex. The national portfolio managed by the Sports Facilities Company generates approximately $200 million in annual hotel revenue. Large-scale youth sports and regional tournaments create a consistent year-round need for transient lodging for families and athletes throughout the entire calendar year. Additional demand will come from the city's 226-acre land bank and the economic development agreement with OSU Wexner Medical Center. OSU Wexner is committed to completing a new facility here by 2031, which will drive demand for extended stay and medical-adjacent lodging. Previously, bureaucratic requirements prevented developers from building the inventory needed to capture this demand. On July 1, 2026, the City Council passed ordinances that rezoned 370 acres, clearing the legislative path for new construction. This legislative shift changed the status of the district's hospitality pipeline from speculative to actionable. Cosgray Commons, a $900 million mixed-use project, is now positioned to propose over 300 keys and a conference center. The rezoning has increased the probability of a formal development filing for Cosgray Commons to 45%. However, new code amendments introduce specific limitations. The new ID6 buffer zone explicitly prohibits conference centers, representing a structural constraint if sited within those boundaries. Because of these complexities, the City Council directed a review of adjacent codes, resulting in a pause on new applications until after the summer recess. The West Innovation District demonstrates that municipal legislation, as much as raw land availability, dictates the timing of institutional opportunity. This map isolates the 210-acre Metro Center corridor, which is moving opposite to the city's hotel expansion. Developers here prioritize residential conversions and adaptive reuse over new hotels. For example, CWP Dublin LLC filed to convert the Sonesta ES Suites into multifamily apartments. This conversion removes an existing extended stay asset from the market, which reduces local supply and helps maintain the performance of the remaining hotels. Across the Metro Center corridor, we are seeing aging commercial assets and outdated properties being actively repurposed and renovated to meet growing local housing demand. The recent acquisition of the Home 2 Suites also suggests a focus on upgrading existing assets rather than adding new room count. While hospitality remains an allowed use under the city's revitalization plan, current market activity does not support new hotel development here. With the pipeline dominated by residential conversions, any underwriting for new hotels in the Metro Center should be pushed back to at least 2028. This chart shows that Dublin's baseline demand is strong, with $4.2 million in bed tax revenue and 14% year-over-year growth. Successfully capturing this growth requires an understanding of how the development pipeline is divided between these submarkets. In the Bridge Street district, current owners must prepare for margin pressure as premium inventory like Tempo and Block Y comes online. In the West Innovation District, the recent zoning changes have created an active pipeline that is now ready to service the demand from SportsOhio. In the Metro Center, the trend toward residential conversion will likely support the RevPAR of existing hotels for several years. In an expanding market like Dublin, institutional survival depends on capital following specific legislative zoning shifts rather than just top-line growth.